Welcome to Dwellings, a podcast from the City of San Jose Housing Department, where we talk with thought leaders about reducing unsheltered homelessness, building affordable housing, and key housing policies. I'm Jeff Scott, and I'll be your host for Season 6 of Dwellings. On today's episode, we talk with Banu San, Deputy Director of the San Jose Housing Department, to learn how new gap financing regulations and underwriting guidelines will change the game for affordable housing development in San Jose. Banu will help us understand the new regulations and why they are so important to the future of affordable housing. And with that, welcome Banu. Why don't you start by telling us a little bit about yourself?
My name is Banu San. I'm the Deputy Director of Production, Preservation, and Asset Management Group in the City of San Jose's Housing Department. And I have been with this department, I'm going in my 5th year now. And my background comes from commercial lending for the past 20 years in the Bay Area.
So why don't we start off with a really general question? What exactly is gap financing when we use that phrase? What are we talking about?
Gap financing is when the borrower puts together all of the financing sources, almost all of the financing sources that is needed to fund a development, the construction of a development. And there's a gap in the last funding stack. So let's say in the affordable housing arena, they are going after private funders. So banks are lending them a construction loan, a construction perm loan, and then they're going after various other federal and state funding agencies. And they're putting together all of the funding stacked together to fund the construction of their development, their project, and coming to the city in this case as the last funder. So whatever funding gap is remaining from that financing stack to cover the total development cost is what they would be coming to the city for. And this is what we are explaining in the recent RFP that we published. The city being the gap financer, meaning come to us last once you have all your funding stacked together, and then let us know what that funding gap is going to be that you're going to request from the city.
Do you see a general kind of rule of thumb, like do most developers need the city to help fill maybe, 10%, the final 10% of the cost of a project, or 15 or 20%? Is there a general rule of thumb that you see with most of your developers?
I think the easiest way to answer that question is to look at our per unit funding. And so a lot of developers, when they're sort of figuring out what it is that they need in terms of the funding from the city, are going off the parameters of the RFP and our funding regulations. So in the RFP that we published, we actually talk about the dollar funding amount being between a certain range. So in the past, it was, for example, $125,000 a unit. So based on the total number of units that they are building, they're going to be sort of looking at what is the max that the city is willing to provide per unit. And in our RFP, in our funding regulations, we make that pretty clear on what range we're willing to go up to. And our scoring in the RFPs are also based on that. So for example, there's very high scores if the developer comes and asks for $100,000 per unit in city funding versus $300,000 per unit in city funding. So I would say it's more defined around that. But if we look at historically, if we look at what percentage of the total TDC the city is financed, you actually have that number pretty close. It's usually between like 10 to 15% at most. But now the environment is a bit different. Our partners as well as our department is more limited in funding, and therefore that amount per unit funding can change year to year based on our funding situation. If you look at the RFP, you'll see that the higher per unit request doesn't really carry any, for example, $300,000 a unit doesn't carry any points, whereas $100,000 per unit has the highest. So it really depends on our funding situation year to year as well.
I understand that the Housing Department, recently rolled out some new regulations for gap financing. Can you explain why we're doing it? What was the motivation or the objective behind rolling out new regulations?
The gap financing program regulations were renewed, revised, completely revamped, whatever we want to call it, this year with the appointment of our new director and new leadership. Really, the purpose of that was to make things a lot more clear to developers on what criteria the city is looking when we're underwriting the proposals, and how do we assess and underwrite and analyze these performance and the overall project. So really it has a purpose of maximizing the quantitative assessments of the proposed developments and then prioritizing projects that are really like shovel ready to go and start construction. We wanted to improve and clarify our requirements for production and preservation for the gap financed affordable units, and then streamlining the regulations, gap financing regulations to CIDLAC, as we call it, California Tax Credit Allocation Committee regulations, as there were some misalignments there as well as reducing the redundancies in the project financing regulatory processes, aligning the underwriting with our partners such as the County of Santa Clara Office of Supportive Housing and the City County Housing Authority, as we're all working in strong partnership in terms of supporting the new developments and preservation projects.
And so can you give us an example or two of how the new gap financing regulations may differ? Like, how did we get rid of an instance of a redundancy, or how did we improve alignment? Just one or two little examples of how the new regulations differ from the old regulations.
First of all, we have separated we used to call them the underwriting guidelines. We've separated them into 3 separate documents, and they're really to simplify things for borrowers. We have the new construction regulations, and that's going to apply to all affordable housing developments, which will be supplemented by a second document called funding regulations. And the new construction regulations just contains very straightforward underwriting requirements for developers to use and implement when preparing their financial projections. So that's majority of it is it's heavy underwriting criteria, and it's, what priorities the city has. So as they're putting their budget together for their development, this is really the reference for in terms of what our requirements are going to be when we assess these proposals. And then the funding regulations applies to all affordable housing, not just new. So the difference between the two is one is for new construction, the other is one for all housing, and contains funding related policies. So it really outlines the policies, our general policies and requirements that are related to, again, affordable housing. And the third one just separates preservation regulations from new construction and all housing developments, and it applies to existing affordable housing developments as supplemented by the funding regulations, which are the policies, and contains requirements for developers that are requesting to refinance, rehabilitate, resyndicate their properties.
So it sounds like the regulations apply to everything, both new construction and the preservation of existing units. And in terms of the RFP that you mentioned a little while ago, are you and your team going to be prioritizing a specific type of project? Are you going to be looking for something specific in the applications you receive through that RFP?
Our key priorities are going to be expanding affordable housing, developments that are shovel ready to go. They have secured entitlements and financing, and prioritizing low cost, high impact projects that maximize the use of the city dollars through leveraging other funding sources as well. So we're looking for innovative funding structures, alternative equity models, lower per unit development costs. So these are some of the priorities that is going to be outlined and has been outlined in the published RFP.
What's the kind of the early feedback you've been getting from developers? Are developers finding these new regulations, these new guidelines to be clear? Do you think that you're getting a positive feedback from them?
I would hope so, as I haven't heard any complaints. And we've held conferences, and we've had some questions further qualified and addressed through those conferences and presentations. And so far, the feedback seems to be positive. The RFP, I would say from the last RFP, which was October 2023, is very quantitative and completely score driven, which makes it much more simpler for developers to sort of figure out, okay, what is their overall score going to be? So when they look at the scoring card, they can put together a preliminary score and understand whether they're going to be competitive or not, similar to what our, tax credit allocation applications are like. So it is much clearer from the last NOFAs that we've done, and it is entirely quantitatively driven in terms of the projects that are going to be awarded and selected. So I think in that sense, it's much more positive. I'm hoping a positive change for developers, and the regulations are hopefully more clear. And I've gotten good feedback about that. So
We have this RFP, and it's my understanding that the RFP is going to remain open for a year. And so that's going to help you and your team score and essentially kind of rank the projects that come in, the proposals that come in. And then can you tell us about the NOFA, which I believe is what you're going to use to then fund the highest scoring projects? Can you tell us a little bit about that NOFA? Like how much money do you think is going to be available through that NOFA, and when do you think that NOFA is going to roll out?
So as you mentioned, it is a 12-month window. So it's got published around, I believe it was April 14th of this year, and will continue April 14th of 2026. And we will be receiving applications as they come in. And that's why we call it sort of a over-the-counter or rolling our request for proposals, RFP. We are intending to release 2 NOFAs. One should be in the coming weeks. So it's pretty close, I would say, at latest next month. And then we're hoping to publish a second NOFA in the fall within this 12-month window. The initial NOFA, we're planning, the preliminary amount is around 50 million. The second NOFA, we haven't determined. We're still looking through our funding situation to see what amount that's going to be. So as the applications are coming in, they're being scored, and the city will be posting the wait list ranking and the scores on our website. And then the NOFA will automatically fund the top scored projects.
If that NOFA, that $50 million NOFA, the first part rolls out in, let's say, June, when do you think projects are actually going to start receiving money, financing from the city?
I would say there will be maybe a few weeks for the assessments and the scoring and the ranking and the publication. So maybe a month or so, depending on staff capacity and how much will be subscribed for the first round. So sometimes we'll have a few applications, other times that'll be a huge wave of like 10, 15 applications that come in. So we'll have to see the amount of applications come in and our staff capacity to get through those.
Does the city offer, does the housing department offer funding or provide funding outside of these NOFAs, or is the NOFA the only vehicle we have for awarding funding to projects?
The NOFA is the only vehicle we have. It is a competitive award process, very similar to the tax credit allocations that developers go after for construction of new or preservation of affordable housing developments. And that is the only way we fund our developments.
Are the developers of affordable housing always nonprofit developers, or are they sometimes traditional for-profit developers?
We have all kinds of entities that apply. So we have for-profit as well as nonprofits, and then sometimes we have joint ventures where we have both in partnership working together. So there's no restriction if that may be the question around who's eligible. Both, we see both scenarios.
For projects that are submitted, do they have to be 100% affordable, or can they be combination of market rate and affordable? How does that work?
Good question. This particular RFP that we published, it's for a construction of new affordable housing. So proposals as well as preservation. It's not going to be funding any market rate. So if a proposal came to us and had an affordable portion to it versus, and then some market rate portion, our funds would not be funding the market rate portion. So let's say it's a phased, it could be, I'm just giving an example of phased development, and they're saying phase 1 is the affordable housing project, phase 2 will be the market rate. They would be applying to the RFP for the affordable housing section. And then in terms of the unit mix, AMI mix, if they happen to have very high AMIs that our funding sources would restrict, we would only fund up to the units that are up to the AMIs that our funding requirements allow. So some of our funding sources, for example, allow up to 60% AMI. So if they had units mixed in their affordable housing proposal where they were above 80 or above 110, 120%, then those units we wouldn't be funding. So we are also restricted by our funding sources as well. But this RFP is not intended to finance any market rate portion or phase of any developments. It is entirely for production of affordable housing developments. For the market rate, I mean, if there is curiosity around that, the city has launched a multifamily housing implementation program in December of 24, and that program purpose was to catalyze market rate multifamily housing projects. Several projects have already initiated through that and are expected to move forward this year. So that is a program that's targeted towards market rate developments.
You used the phrase AMI a few times, and I think you're referring to area median income, just a measurement of household income.
That's right. Thank you for noticing that. Yes, that's what an AMI stands for.
For those of you listening at home, we do have an asset management team that makes sure that all of the affordable housing that we help fund complies with those regulations, those AMI regulations that Banu mentioned.
Right. So, I mean, so we have those funding regulations and our policy regulations, and our asset management group also, will go by those. So I encourage developers to review our regulations in detail before they apply for funding to the city, and also share those regulations with other lenders and funders so that they're also aware of what our requirements are. As the last thing we want is like towards the close of financing for other lenders to come and say, we're not okay with your policies and here's ours, and then there's a conflict. So we encourage developers to share our regulations very early on and to be aware of what we're requiring. Our asset management group ensures compliance against with those regulations once the developments are funded and construction is complete and it's now in operation.
Well, Banu, thank you. This has been a very enlightening, very helpful conversation. Is there anything else that you would like to add? Any points about the RFP or the NOFA, or just gap financing in general that you'd like to add?
I mean, a message for developers. I mean, you are encouraged to review your portfolio and align your development strategies with restricted local, state, and federal funding at the moment, and really clearly prioritize the projects that you want to move forward with. For prospective tenants out there, the city continues to support the developments of new affordable housing developments in the city of San Jose. So I would say be on the lookout for those, and we hope to see a lot more developments towards the end of this year, start construction, as well as new developments coming for you next year.
Thanks for listening to Dwellings, the City of San Jose Housing Department podcast. Our theme music is Speed City, composed and performed by Attain Charles. Thanks to San Jose Jazz for letting us use their music. If you like the show, please subscribe and share with your friends and family. If you're looking for more ways to help address housing and homelessness issues in San Jose, please check out the show notes. You can follow the Housing Department on social media. We're on Facebook, Instagram, and Twitter at SJ City Housing. And if you have questions or comments about today's episode, please send them to housingcoms@sanjoseca.gov. The artwork on our website was created by Chelsea Palacio. Dwellings is produced by me, Jeff Scott, and Jose Chavez of the Housing Department.